Uh, Time to go through the markets real quickly from last week. And last week we just highlighted that we had the worst weekly performance in the S&P since during SVB. Well, this week we had the best performance since the beginning of the Fed pivot, which led to a continuous rally in stocks that ended the year and continued obviously into the first 6 to 8 weeks of the year. So a big week for stocks. In terms of the drivers last week, it was the ones that had really been leading the whole year. But I think the main point to take was this rally was not some narrow breath, except for energy. Every sector was up. The overall returns were 4%. Equally as important, since we've had a lot of people that have been worried about a recession. The breadth in the market is still very good. We almost got to new highs in breadth. This has not been at any point this year explosive breadth. We've heard about the negative side, but the NYSE cumulative advanced decline line is near the highs, and so that continues to go. What has lagged and what is part of the regime shift that I believe not only is happening, but the one that I think people need to focus on as AI has lost, I would say, the euphoric stage of the bubble. You can see that NDX versus the S&P barely budged. This is the S&P up here. This is the AI pair, so the Goldman Sachs AI winners versus AI losers barely bounced, and NDX over S&P. So this was not led by the NDX from the lows. And what has gone, or the divergence is not only there, but I've seen a lot of people get fixated on the yen carry trade. I did a Substack writing this week, my first one, and on there I just highlighted the fact that there's this continuous parade of recession fears that have been going on for the last 4 years. I go through them. There's too many to talk about, but the reality is the yen carry one's the one I've seen in Twitter, and the one I've heard people talk about is some massive deleveraging event. The reality was we had a regime shift. It was driven by the reality that the Fed is going to cut rates, and right now, as is built in the market, more aggressively than what people had thought before. So the blue line here is the S&P back up near the all-time highs. The divergence, which started right here in at basically the prior highs, which were somewhere between the 8th and the 15th, right around when the CPI came out in July, you started to get an unwind in a bunch of these trades. I highlighted this in a video back in late July that there had been a contagion of unwinds. Well, the green line here is dollar yen. This line here is the AI pairs. And the white line there is Fed expectations. So as it became obvious that the Fed was going to cut rates more aggressively than what people thought, you had a scenario that people had a choice. They could either say this is positive for the market, the Fed's about to cut rates and that's going to be good, or you could jump to, well, that means things are really bad and we're going to have a recession. And that's what people did. And the reason is because the assets started to shake. A regime shift always catches people off guard. And because this was at that point an Nvidia unwind, a lot of the mega cap next tech names that had done well, you had this scenario that the S&P, as of through August 5th, these were the sectors that were leading into that point. So this is the lows in August 5th. These were the leaders. So at the lows, the S&P was only up 9% for the year. It had been up closer to 20 before that. So you had this correction, and these were the names that were leading from there. From the lows, still about the same names. Obviously, commercial services here, which includes Netflix and Google and Meta, didn't bounce as much. But again, even from the lows, we still saw good breadth. There are new leaders, though, and this goes back to that July 8th to July 15th period. So again, the white line here is the December Fed fund expectations. There's now 116 basis points of cuts built in. Back then, there were about 50 that were built in. And so we've had an extra 65, 66 basis points as of Friday. What you have here is groups that have led now, and these are mainly the defensives. So you've got food and beverage, you've got real estate, and the financial side, you have the insurance companies, and then you also have the home builders and things like that. So the interest rate sensitive, which had really been underwhelming the market for most of the year because of where rates were, they got to budge. This week, I think the main story for people was, despite the fact that the AI bubble has peaked and you saw a significant decline in Nvidia, it was a reset. And I highlighted this in the last webinar that we almost got down to unchanged on a rolling 6 month basis. That's the same place we were in December of last year. Now, I showed this because this is when ChatGPT was launched. So the rate of change on Nvidia to me has been an important gauge for a resetting of expectations, a resetting of the market. Think of it as a consolidation side. And the reason is because it's insane to me that people still are trying to fade AI and not understanding how much more there is to come. To me, this is like fading the software movement, not in 2018 or 19, but in 2010 or 11. It's still very early in this, and even though there's been a tremendous amount of chip demand and we haven't seen the revenues come through, it is a major part of this, and it's still showing up. In fact, Sept, in their earnings insight, they just highlighted the number of S&P 500 companies that are citing AI on earnings. This is going to continue to grow. Everyone's bringing it into their business, and the way that you see this again, and the reason that it is very dangerous to fade AI from a where are the revenues basis is it's going to show up a lot in profit margins. So this is the profit margins with increase or decrease in the second quarter of 24, the one we just finished, versus second quarter of 23. And you can see just, again, the percentage is the green line. Every single sector in here is basically right around 50% or higher. And so you just have to be careful when you get too negative on this stuff. I said it in there. I've seen some responses. People just, for some reason, want to be fixated on this recession side. Outside of the equity market, I'm just going to highlight again, the junk market has not moved. So junk spreads are still sitting there. We had a little move up and we immediately came right back down. As I mentioned, we have a lot of cuts now in the marketplace. So you've got about a 50-50. You got 37 basis points in for the September meeting, the November meeting. You have now a total of 3 quarters. And then for the December, you have 120 basis points. I don't think they're going to end up doing that much because I think the economy is going to see a bump back up. But the fact that they are doing this with financial conditions already back to the levels they were before the rate hikes and back to the levels they were before COVID in general, I just think it's, cutting rates when the economy just is fine, to me is going to lead to another bid underneath the surface as long as earnings are coming through. In terms of the economic data this week and just what people should take out, make sure you get some details on it. Core or CPI came out. This is, I've shown this chart many times. The white line here is the 5-month average of the core sticky X shelter. And what you have here is that has come back down to 2%. This is core CPI. This is it back over the last 40 some odd or 50 some odd years. There's no way to get through that inflation isn't coming down. I do want to make sure that people realize I still believe that inflation is not coming back to where it was. This is the core services, or this is the breakdown of CPI by all the different components. And what you can see here is the white here is the core services, which are still sitting around 3%. You have things related to commodities for the most part and the home builder side, which are negative. But I bring this up just because it has, you still have inflation that's going to be sitting at higher levels with the Fed cutting rates. I don't think we're going back down to 2%. Michigan inflation expectations have gone all the way back to where they were before COVID. The jobs market, I'm going to keep showing these charts. I think this is a better way to show it. Until we start seeing any kind of rise in claims that shows up on a continuous basis, this is the data that people should be watching and not focusing on, well, we only created 115,000 or revisions are going lower. Until people start losing work and collecting insurance, and most importantly, can't find a job. So it's one thing to get unemployment insurance. It's another thing to get on continuing. We just don't have any uptick in this. So just, there's no recession staring us in the face at this point. We are going to have lower GDP. We are going to have a job market which is more in line. But we don't know what's going to happen when the Fed starts cutting rates and some of those interest rate sensitive groups start getting benefits. In terms of inflation, I just want to highlight something I tweeted about this week. We just saw the largest monthly drop in online grocery prices. This is important for people living paycheck to paycheck. That's still an enormous amount of Americans, and this is one of the reasons that we've had such a low thing in consumer confidence. You want to watch how food and gas are doing, and I've highlighted this before. Gas is down again. This is a weekly chart. You're now down for, I believe, the eighth week in a row, or seventh, yeah, seventh week in a row, 8 of the last 9, and there's more to come. Here's gas futures, the second contract. This is the overlay with gas at the pump. We're right now tracking that this would be the lowest gas price, unless we see a big bounce back up in unleaded gas futures, in the last 3 years. And so we're getting a big move here. We also got data that doesn't get followed that much, but you saw a bounce back in retail sales using the red book. This is what should happen. If all of a sudden we're seeing gas and food prices drop down sharply, you're going to see a transfer into retail sales. This is a Johnson Red Book. Year over year, just jumped back up to the highest level, believe it or not, since the fourth quarter of 22. This is the overlay. The white line here is the Johnson Red Book year over year. This is it overlaid with advanced retail sales. We'll be getting this number there, but you can see that we made the highest level since the fourth quarter of 22. So you have that. When you get that, this is a chart I showed last week. I'm just going to emphasize this again. The white line here is the City Surprise Index for the G10. It's bounced now. It is going higher. This is gas at the pump. As gas at the pump gets lower, we generally start to see a shift in this. As long as we're not in a recession, gas at the pump starts to matter a lot. And it comes at a time where when you overlay the City Surprise Index with Fed funds versus, 2-year rates less Fed funds, you're at minus 191 basis points now. So we're just at a point where people expect a recession. You've got gas at the pump falling, you got food coming down, you have profit margins still in there. We've had the reset on the AI side. I think we've now found a stable point. We've had a rally. I think the Fed meeting coming up, as long as triple witching, once we get through those 2 data points and things settle down, if we don't have another move to the lows and we're actually sitting around here, I think again this will be another one of these transitory recession fear bombs that takes place, and everyone will start to focus on the end of the year and moving into next year in an economy that's fine and earnings that continue to grow. That's it for me. I'll try to put one together next week. Thanks. Bye.